Have you ever looked at your savings account and thought, is this it? Is my money just sitting there? What if I told you there's a way to make your money work for you, to grow it over time, and build real wealth? Today, we're demystifying the U.S. stock market. Forget the confusing jargon and the intimidating charts you see in movies. By the end of this video, you'll have a clear, step-by-step roadmap to start your investing journey, even if you're starting with just a small amount. We'll cover everything from what a stock actually is to how to buy your very first one and, most importantly, how to avoid those common beginner mistakes that can cost you. So, grab a notebook and let's get you on the path to becoming a confident investor. First things first, what exactly are you buying when you buy a stock? Imagine a giant pizza. When you buy a stock or a share, you're buying a tiny slice of that pizza. The pizza represents a company like Apple or Nike, or maybe a company you love like Starbucks. Owning that slice means you're a part owner of the company. If the company does well, makes a lot of profit, and grows, the value of your slice can go up. If it does poorly, the value can go down. It's that simple. You're not just gambling, you're investing in the future success of a real business. The goal for most people isn't to get rich overnight. The real magic of the stock market is long-term growth, powered by something called compound interest, which Albert Einstein supposedly called the eighth wonder of the world. It's your money making money, and then that money making even more money. So, how do you actually buy these slices of pizza? You can't just call up a company and ask for a share. You need to go through a stockbroker. Now, don't picture a guy in a suit yelling on a trading floor. Today, your broker is an app on your phone or a website on your computer. These are called brokerage accounts. There are many great user-friendly options out there like Fidelity, Charles Schwab, Vanguard, or even apps like Robinhood and Webull. And opening an account is usually free and takes about 15 minutes. It's a lot like opening a bank account. You'll need to provide some personal information like your social security number and link your bank account to transfer money in. These platforms are designed for beginners, with tons of educational resources to help you along the way. Take your time, compare a few, look at their fees, though many now offer zero-commission trades, and pick one that feels right for you. Okay, your account is open and you've transferred some money in. Now for the exciting part, choosing what to invest in. This is where many beginners get overwhelmed and either freeze up or make impulsive decisions. So, let's break it down. Instead of trying to find the next big thing, a fantastic starting point for almost everyone is an ETF, which stands for Exchange Traded Fund. Think of an ETF as a basket that holds hundreds, or even thousands, of different stocks. Instead of buying one slice of pizza, you're buying a tiny piece of many different pizzas all at once. For example, an S&P 500 ETF with tickers like SPY or VOO gives you a piece of the 500 largest companies in the U.S. This is instant diversification. If one company in the basket has a bad day, the other 499 can help balance it out. It's a much safer and more stable way to start than putting all your money into a single company. You're essentially betting on the success of the entire U.S. economy, which historically has been a very good bet over the long run. Now, let's talk about a crucial mindset shift. You need to stop thinking like a trader and start thinking like an investor. A trader tries to time the market. Buy low, sell high, often in a short period. This is incredibly difficult even for professionals. An investor, on the other hand, buys quality assets and holds them for the long term. We're talking years, even decades. They let time and compounding do the heavy lifting. The market will have up days and down days. It will have good years and bad years. This is completely normal. The key is not to panic when the market drops. Panicking and selling when your stocks are down is the #1 way beginners lose money. Remember, you only lock in a loss if you sell. If you believe in what you've invested in, like the broad U.S. economy through an S&P 500 ETF, a market downturn is just a temporary sale. It's an opportunity to buy more shares at a discount if you can. One of the most powerful strategies for a beginner is something called dollar cost averaging. It sounds fancy, but it's super simple. It just means investing a fixed amount of money on a regular schedule, say $100 every month, no matter what the market is doing. When the market is high, your $100 buys fewer shares. When the market is low, that same $100 buys more shares. Over time, this strategy averages out your purchase price and, more importantly, it removes emotion from the equation. You're not trying to guess the market's next move. You're just consistently investing, building the habit, and staying disciplined. Many brokerage platforms even let you set this up automatically. It's the set it and forget it approach to building wealth, and it works. Let's address the elephant in the room: risk. Yes, investing in the stock market involves risk. The value of your investments can go down. But let's put this in perspective. Keeping all your money in a savings account also has a risk: the risk of inflation. Inflation is the rate at which the cost of living increases. If your savings account pays you 1% interest, but inflation is 3%, you're actually losing 2% of your purchasing power every single year. Your money is slowly becoming less valuable. Investing in the stock market is one of the most effective ways to outpace inflation and actually grow the value of your money over time. The key is managing risk through diversification, not putting all your eggs in one basket, and having a long-term time horizon. The longer you stay invested, the more time your portfolio has to recover from any downturns. So, let's recap the beginner's game plan. Step 1. Open a brokerage account with a reputable, beginner-friendly platform. Step 2. Transfer in some money you're comfortable investing, money you won't need for at least 3 to 5 years. Step 3. Instead of trying to pick individual stocks, start with a low-cost, broad-market ETF, like an S&P 500 fund. This gives you instant diversification. Step 4. Commit to a long-term mindset. Don't panic during market dips. Step 5. Use dollar-cost averaging by investing a consistent amount on a regular schedule. This builds discipline and removes emotion. Following these 5 steps will put you miles ahead of most beginners and set you on a solid foundation for your investing journey. A final word of advice: never stop learning. This video is a starting point. Read books, listen to podcasts, and follow reputable financial news sources. But be wary of hot stock tips from friends or social media. Your financial journey is personal. The most important thing is that you've decided to take control of your financial future. Getting started is the hardest part, and you're already tackling it just by watching this. Don't be afraid to start small. Even $20, $50, or $100 a month can grow into a significant amount over time thanks to the power of compounding. The best time to start investing was yesterday. The second best time is right now. Thank you so much for joining me today. I hope this has made the world of stock market investing feel a lot more accessible. If you found this video helpful, please give it a thumbs up and consider subscribing to the channel for more content designed to help you build wealth and live a richer life. If you have any questions, drop them in the comments below. I'll do my best to answer them. Now go open that account and take your first step. You've got this.